the Balancing Act podcast with Singer Liwak, where we delve into the latest trends and insights in the world of business and finance. Today, we're excited to kick off the first episode of our three-part International Business Insights series. In this episode, we focus on the intricacies of cross-border mergers and acquisitions. Joining us are international practice leader Robin Park and audit partner Suzie Doran. Together, they will share the invaluable insights and best practices on navigating the complex landscape of cross-border M&A. Whether you're a seasoned professional or new to the field, this episode is packed with essential information to help you succeed in today's global economy. Let's dive in.
Hey everybody, welcome to the Balancing Act, the podcast where we chat about all the business stuff that companies deal with. I'm Suzie and I'm here with my partner, Robin Park. Today we're going to talk about the lifestyle of a cross-border M&A deal. Maybe before we start, Robin, do you want to just introduce yourself and kind of give your background?
Sure. Thank you, Suzie. My name is Robin Park. I'm a partner here at Singer Liwak and lead the international practice. So anything that's cross-border, I will help kind of facilitate and coordinate those provision of services. And as it specifically relates to this webcast, it would involve transaction advisory services. So as we'll cover during this podcast, starting from due diligence to pre-acquisition structuring, and then post-acquisition integration considerations, we cover soup to nuts, the entire life cycle of a cross-border M&A deal.
Okay, good. Well, before we get into such a dense topic, maybe we can start with a little bit something lighthearted. Halloween's coming up. Are you dressing up?
I won't, but oftentimes I will get mistaken for a basketball player named Yao Ming because I am 6'6". But apart from that, I will not be dressing up.
Yeah, I don't normally dress up, but I may be dressing up this year. We might be doing a theme with our kids, so they kind of tell us what to do. But I think they want to do inflatables, and I think that will be it'll be interesting to see 4 inflatables and see if we can actually walk straight.
That should be fun.
Yeah, so great. Well, let's just talk quickly about just kind of our background and our cross-border M&A experience. I have some M&A experience. I've been doing M&A since probably before I joined the firm. I started in the M&A financial due diligence buy side at Grant Thornton. I'm involved with it primarily with clients, just kind of giving advisory work when they have a transaction. In fact, I'm working on one that is dealing with a buyer that is in the UK right now, which has been really interesting. And Robin, can you give a little bit of background on what you do?
Yes, so similar to Suzie, I've been working the M&A and cross-border M&A space for really since starting my career, so for over 20 years. Deal work has always been an important part of my practice, and just whether it's coordinating the tax due diligence, both from a domestic and local country perspective, as well as pre-acquisition structuring, which is very important because you really want to get the structure done correctly on the front end, and then once everything has been consummated and the deal has been closed, we'll then work with, if we're, for example, on the buy side, the post-acquisition integration considerations. So making sure, we're looking at everything and, eliminating any sort of duplicative functions and entities, really streamlining the structure and maximizing the synergies of the acquisition.
Great. And I think what's happening right now is we realize that with COVID, you don't actually need to be in person. And so what ends up happening is everything just gets a lot quicker. It's a little bit more seamless. You can do telephone calls, you can do Zooms, Teams, all of those kind of things. And we just live in a global economy. Most, and if not all, companies I know that go through transactions will normally not just close it out so that it's really related to domestic financing, but I find more and more that there's some international financing, international buyers involved with that. I think that's been kind of my experience. Has that been something you've seen as well, Robin?
Yeah, no, absolutely. I mean, over the years, the M&A world has become borderless. So you're finding, whether it's, even if it's a purely domestic acquisition of two entities in the U.S., oftentimes you will find that, behind the ownership, you have foreign owners, right, or non-U.S. owners. And as you mentioned, they're also getting financing from overseas. So it is becoming again a global, much more of a globalist view when it comes to M&A. Even when you think you're just dealing with two, let's say, purely domestic entities involved in the transactions.
Right. So it's really important to understand the different rules in different countries. As an example, we did some work or are doing some work, Robin. We have some Japanese clients, and whether that's Japanese GAAP, whether that's IFRS, understanding that from at least from an accounting perspective is important. And I believe for you, the the tax mandates are going to be a little bit different. So we do work with advisors in Japan to just make sure we're aligning right and on the same
Yeah,
basis.
that's right. There's a common misnomer when people hear that I'm an international tax professional. They think that I know all the tax rules of all the different, hundreds of different countries in the world. And, although I wish that were true, my area of focus is really on the U.S. rules and how, the U.S. international rules impact, our clients, whether we're on the buy side or the sell side. And oftentimes, when it does involve a multi-jurisdictional or cross-border M&A deal, I will have to coordinate and work with my counterparts in the different countries. So as I was saying earlier, we're not necessarily subject matter experts of every country, but we do always coordinate with our counterparts, whether it's a deal involving a Japanese, buyer, or whether it's a European UK buyer, for example, or seller. We would have to coordinate with the local country tax professionals to make sure that we're covering all of the diligence, for example, from both perspectives.
Great. So let's dive into kind of what that actually means when you're going through kind of financial due diligence. What I found is that, sometimes the terminology is a little bit different, but the concepts are the same. So, for example, I've worked in the UK, and turnover is not actually just kind of a pastry that you eat, but it actually represents revenue. Uh, so I'm sure that there's some differences there, but the concept of EBITDA as well, sometimes they call that a profit before taxes. But at the end of the day, conceptually, it's the same process. So what we normally will do is we'll do financial due diligence, and financial due diligence will encompass not just tax structuring, but also accounting, because normally the purchase price or the enterprise value is predicated upon either a multiple of revenue or EBITDA or whatever terminology you use. So maybe I can talk a little bit about the accounting aspects of it, but tax structuring is probably really important. So maybe you can talk a little bit about that and what you do from that perspective.
Sure. So yeah, the tax diligence is always a very important consideration in that cross-border M&A deal. This is really the time that we can kind of dig into, let's say, the target company and try to find, all the contingent or let's say hidden liabilities that may be buried in the documents. Um, so it's very important. And again, as I mentioned earlier, we really work in tandem with our counterparts. If it is a cross-border deal or even a multi-jurisdictional cross-border deal, we would always have to coordinate to make sure that they're looking at, reviewing tax returns, for example, in their countries, or financial statements, transfer pricing documentation, just going through all the relevant documents that we would typically request that be uploaded into the data room. And again, that's where we really put on our hat. It's almost like an audit function where we're kind of going in and just uncovering and unearthing any sort of, again, uh, contingent or hidden type of liabilities that you may not see right off the bat. And that really
I think
provides. Huh?
oh, go ahead. Sorry about
And I was
that.
just going to just say, I mean, the value proposition there is that obviously, is if we do uncover anything, that could potentially be a deal point and result in an adjustment to the overall purchase price.
Right. So I think there's a multiplier effect, right? So if it's multiple EBITDA, for every dollar that you find as part of your due diligence or every dollar that you don't find, there is a multiplier effect, especially if it hits the P&L. So when we talk
Mhm.
about those kind of things, um, taxes, and that's what I'll talk about with financial due diligence, from at least an accounting perspective. But from a tax perspective, when people ask us about tax due diligence, I believe you would be quarterbacking it, and we actually at the firm have the ability to deal with, at least with all the domestic aspects, which is structuring whether it should be an asset or a stock deal. Is that right, Robin?
Right, exactly. And it kind of in conjunction with the tax due diligence, we always look at pre-acquisition structuring on the front end, right? So, and oftentimes, you'll get two divergent views because on the buy side, they typically want an asset deal, and then on the sell side, they always want a stock deal. And it's really then, kind of, through our assistance to help them understand the pros and cons of each and try to come to a comparable middle ground. And sometimes you can get the best of both worlds. Because there are certain elections here, at least in the U.S., you can make like a 338 election, where you can treat a stock acquisition as like an asset purchase for U.S. tax purposes. But oftentimes in the domestic context, that will require consent from the seller to make that election. But if we're talking purely in the international context, involving a foreign or non-U.S. entity, you could unilaterally make that 338 election. However, if the seller does have a savvy attorney, though, they will often put provisions in the agreement where they will preclude or prohibit the buyer from making a 338G election, because there are implications for that for the seller in terms of lost foreign tax credits and so forth. Um, but getting back to the kind of the original point, it is very important to get the pre-acquisition structure, agreed to, stipulated to on the front end. Um, and as I was mentioning before, you know, the buy side will always want assets because when it's an asset acquisition, you're taking on less successor liability as opposed to a stock deal where if the buyer is buying all the stock, you're effectively inheriting or assuming all of the liabilities of that company. And so again, oftentimes the buyers will not want a stock deal, but they'll want an asset deal. But as I just mentioned earlier, there sometimes is a compromise with this 338 election.
Right. And I believe that, Robin, since your focus is kind of on international, what you would do is be able to bring in the right people from the Singer Lewak side that can help with, for example, the pre-structured deal. And then I believe there's other issues that may come up. For example, if there's any potential nexus issues, if the company is not selling in just one state and in other states. And I believe we can bring in our tax people to help with that as well. Is that right?
That's absolutely right. So you really have to look at it, at least from a domestic or U.S. perspective. Like, I'll typically handle the federal aspects, but as Suzie alluded to, the state and local tax implications are just as important, and sometimes really the area where a lot of the diligence will focus upon. Because as Susie mentioned, you have to look at also all the state and local tax implications, both from an income tax perspective as well as a sales and use tax perspective, and in some cases property taxes as well. It gets much more granular when you involve the state and local tax consequences. So, but as Susie mentioned, we do have a very strong state and local tax team that we always work in conjunction with in any of these type of cross-border deals.
So there's a lot to do from a tax perspective. It's really important that you get it, not only understand what it is in terms of how you're going to structure it. For example, let's just say as a seller, you actually want to do a stock deal, and as a buyer, you want to do an asset deal. Well, maybe you would adjust the purchase price so that if, for example, the seller says, "Hey, I really want you to do a stock deal," and the buyer says, "I'm going to do an asset deal, and it'll be more advantageous for me to do that," then maybe you have to actually increase the purchase price a little bit. That's all things that happen with your tax team. You also have to look at your potential nexus issues that Robin was talking about, and then you want to look at kind of international. And I think that's kind of where you really specialize, Robin. So maybe tell us a little bit about why is it important to have a transfer pricing report?
Yeah, so from the international cross-border perspective, not only do you have to look at the domestic considerations, but you also have to coordinate with my counterparts across the pond, so to speak. Let's say dealing in the EU or the Asia Pac region, because there are unique taxes associated in those respective countries. And so, for example, there could be value-added taxes, there could be stamp duty taxes, as well as the various types of income taxes in all the different jurisdictions. So it is critical to understand the landscape in both jurisdictions, both from here in the U.S. as well as abroad. And then another concept that Susie alluded to that cuts across both jurisdictions is the concept of transfer pricing. And so transfer pricing is very important. It's a hot button, a global issue that all the tax authorities are aware of. And basically, what transfer pricing is ensuring that all related party transactions are on the same parity as though you're dealing with unrelated parties. So, for example, if you're in the business of selling widgets, um, if you were, selling to unrelated parties, you would sell them at whatever your markup is, whatever you negotiate. Uh, Similarly, if you're selling to a related party, you wouldn't sell your widgets to your related party at cost, right? Because there would be an expectation you're going to make a profit when you're making these sales. Because otherwise, why would you be in the business of selling widgets if you were just going to be breaking even or in a loss every year? So at the heart of the matter, transfer pricing is there to ensure that again that all related party transactions are on the same parity as though you're dealing with unrelated parties. And again, it is a hot button, and all the tax authorities are looking into this issue. So it is a very important part of the diligence and making sure that all the transfer pricing and the documentation, the contemporaneous documentation that is required in all the different jurisdictions is being met. Otherwise, that again is usually a big deal point in a lot of these cross-border M&A deals.
Okay, so just to summarize, basically, when you do transfer pricing, basically, you're just trying to make sure that you have a study that basically represents that those transactions that are being done, for example, management fees, any basically fees that are charged between two kind of related parties, especially if this is a transaction, are really going to be done at a level where you're not really looking to just funnel money to and from those countries. Is that a good summary, or is there anything
Yeah, no,
else?
that's right. I mean, it depends on the nature of the related party transaction. It could be a management fee, it could be a licensing and exchange for royalty payments, it could be the sale of tangible property between affiliates, or providing services between affiliates. But the point is that those transactions must be at arm's length, and that you should also have contemporaneous documentation to satisfy the local country requirements, because oftentimes um, the local jurisdictions may require that you file and attach something on their annual tax filings, for example.
Okay, great. So I think basically the summary is you want to make sure that you're not leaving any money on the table. You want to get your tax people involved, not only from a pre-structuring perspective, you want them to be involved during the negotiations, and you want to know what your potential liabilities are, whether they're going to be from a foreign basis or a domestic basis. From a financial due diligence perspective, the important thing is you do a quality of earnings report, or you get usually the buyer. A lot of times we do sales side and buy side due diligence. And when you do sales side due diligence, you kind of write a book and you get an Excel book that basically does an adjustment from however your books are done to a GAAP basis or whatever the actual applicable reporting standard is, whether it's IFRS, Japanese GAAP. And so the point is you're trying to figure out any adjustments that are going to impact your EBITDA or your revenue. And that will basically result in a difference in your purchase price. Usually for tax, I believe that the impact is that you will accrue that money and it'll be part of the escrow, which gets held and released once those tax liabilities are basically deemed to be finalized. Is that right, Robin?
Yeah, that's right, and that's a very important consideration as well as the escrow piece. And now we get questions as to how long the escrow should, remain open, because obviously the liabilities may not arise until sometime after the close of the deal. So it's not uncommon to see an escrow be held open for 6 months to even up to, I've seen situations up to a year or longer. But that's, yeah, I think what you said is definitely on point.
So it's very important when they do a transaction, despite the size, there's still a level of work that needs to be done. You'll be working not only with your accountant, you'll also be working with your attorney, and sometimes you'll work with, for example, an IT individual to talk about, if they do this transaction, are they going to be able to absorb the current entity? Maybe you'll do some due diligence on kind of the culture, both post and pre. But at the end of the day, the financial due diligence is really what drives the purchase price, the number of amounts that are held in escrow. So it's really important that you do that kind of as early as possible and get us involved. I think that's pretty much a recap of our key points. Is there anything else that we missed, Robin?
Yeah, I think the last part I wanted to just touch upon is kind of post deal or post acquisition integration. So once the deal in principle has been consummated, if you're particularly on the buy side, you will then want to then kind of assess the structure kind of post acquisition, and that gives an opportunity to really kind of streamline the structure, eliminate duplicative functions or entities, because let's say as a result of the acquisitions, let's say you previously had one UK entity and a Japanese subsidiary, but now after the acquisition, you acquired another UK and Japanese entity. So that gives an opportunity to maybe streamline the structure, and they merge, the two UK and Japanese entities into one, or liquidate one and transfer the assets to the other. And then also align the transfer pricing to make sure that the entity or the target group that you acquired, that the overall transfer pricing of the buyer is also aligned and pertains to the acquired group of entities. So weaving that into the overall structure is also an important consideration as well.
Well, that's actually a great way to seg into our next episode, which will be coming up in this series, which is labeled appropriately transfer pricing. So, Robin, sounds like that's something that you probably get a lot of questions on, and it sounds like that there will be a whole episode just focused on that, right?
That's right. So we'll go in pretty deep into transfer pricing on the next podcast, and I hope everyone here will be interested in joining as well. Because again, transfer pricing is a global hot button. It's here to stay, and you really want to understand what you need to do to comply with these rules.
Well, that's it for this episode of The Balancing Act. Signing off, Suzie Doran, Audit Partner, and
Robin Park, International Tax Partner.
That wraps up today's episode of the Balancing Act podcast with Singer Liwak. We hope you found our discussion on cross-border M&A both informative and engaging. A big thank you to our guests, Robin Park and Suzie Doran, for sharing their expertise and insights. Stay tuned for our next episode in the International Business Insight series, where we'll dive into the topic of transfer pricing. Thanks for listening.